Just when you thought Hesai was purely an automotive play, building those invisible airbags for electric cars, they're suddenly flexing muscles for humanoid robots. It's August 18th, 2026. Welcome to Earnings Unscripted. We're unpacking Hesai's second order, ticker HSAI. Mero, top line hit roughly $127 million, up about 27% sequentially. It's their fifth consecutive GAAP profitability, but the robotics news totally hijacked the spotlight.
Yeah, completely hijacked because, the core auto side performed exactly like it should ahead of the seasonal ramp, right? Shipments were robust and consolidated gross margins expanded nicely back to 40%. But their new robotics segment, the strategic growth initiatives, went from absolute zero last quarter to posting massive revenue. It easily surpassed their initial expectations, and that kind of swings the whole valuation framework.
Right, so the stock reaction was just as chaotic as that pivot. It spiked pre-market, actually gapped down hard at the open, then ground its way back up all day before finally closing down about 6%. And obviously, as we debate if Wall Street's having an overreaction here, please remember our theories are purely personal views, not financial advice.
Well, the market's just deeply confused. Investors thought they held a high-volume auto parts supplier. Now they're suddenly holding an active robotics infrastructure company. And it's not just a fluffy lab demo either. They literally took their robotic actuation modules, the muscles basically, and deployed them on a robot making blizzards at a fully operational Dairy Queen in Shanghai. No custom guardrails, just real-world zero-retrofit utility.
Wait, back up. A real Dairy Queen? They just dropped a robot next to the soft-serve machines and let it run autonomous prep?
Exactly. They're trying to prove they don't suffer from model collapse by forcing the hardware to handle entirely unpredictable environments. It proves they aren't just an optics company anymore.
Okay, I love that, but I need to jump back to the financial reality for a second because the income statement is breaking my brain. Net income basically, it essentially quadrupled sequentially, but then you look at their actual EPS print of 0.05 RMB, and it looks like per-share earnings just fell off a cliff compared to last quarter. The math feels totally disconnected from reality unless there's a trick hiding in the footnotes.
There's absolutely a trick, and it catches lazy models completely off guard. They did a 1-for-8 share subdivision right at the start of July, so that GAAP earnings per share print utilizes a new base of about 1.3 billion shares applied backward for the optics.
Oh, okay. So they essentially just flooded the pool with new shares, which dilutes the actual earnings value per investor, making it look artificially terrible?
No, you aren't losing equity. It's just a straight stock split. You have the same slice of the pie, they just cut the pie into way more pieces. If you try to directly compare the second quarter adjusted number to the unadjusted basic share count from the first quarter, it visually looks like per share profit vanished, but total net income actually soared.
Okay, pie remains intact. Got it. I was about to say, crashing your own metrics on paper takes a special kind of masochism. But speaking of things soaring, we've got to talk about the SGI guidance. Bumping the full-year target from 100 million RMB up to the 200 or 300 range, that's an aggressive revision for a segment that literally just launched.
True, but there's a massive asterisk attached to that demand. That explosive adoption for those actuation modules, driven heavily by a humanoid manufacturer called Sharpa. And Sharpa happens to be co-founded by Hesai's own CEO, David Lee.
Wait, really? So they're essentially just selling to themselves.
Legally, it's a related party transaction. They actually had to ask shareholders to raise their supply cap to satisfy Sharpa's order volume. And look, it scales the division wonderfully, but you have to wonder how much of this momentum's genuine open market pull versus a captive customer just juicing the numbers.
That feels like a pretty crucial detail for the valuation story. If Wall Street's pricing them like the next robotics infrastructure king, they probably want to see arm's length buyers, right? But the CEO sounds incredibly convicted. I saw he was talking about how one robot might need over 100 modules.
Right, and that's the grand thesis. Quote, actuation can be more than half a robot's BOM. One humanoid may need over 100 modules. Run that math and long-term demand approaches 1 trillion units. He sees the hardware transition clearly, but you gotta separate his long-term vision from who's actually signing the checks today.
1 trillion units. It's hard not to get swept up in that kind of scale, but they're also facing some intense pricing pressure on the automotive side, aren't they? Even with volume jumping, the average selling price on LiDAR keeps dropping.
Yeah, the price war in the Chinese hardware ecosystem's brutal right now, but management's overtly refusing to play the race to the bottom game. Their CFO, Andrew Fan, basically said, quote, "As the leader, our goal is not 100% share at any cost. A destructive price war is the worst outcome for everyone. It starves technology, quality, and safety."
Which is a very Apple-esque strategy, right? Protect the profit pool rather than bleeding out for unit volume. But to hold the line on margins, you need leverage. Do they actually have that kind of leverage with car makers?
They do, purely because of changing regulations. China's mandating strict safety standards for autonomous driving next year. So the era of slapping a single sensor on the roof's over. You've got brands building out multi-LiDAR arrays right at the factory level, going from 1 unit to sometimes 2 or 4 per car, just to create redundant blind spot coverage.
Oh, so that's where the whole invisible airbag concept comes in. You don't bargain hunt on airbags when the government's demanding redundancy.
Exactly. The CFO explicitly compared their position to Apple and smartphones. He said people obsess over unit share and completely miss profit share. So they're perfectly fine letting competitors take losses on cheap, low-end sensors while they sit up on a 40% margin hill.
But if half their top line shifts away from auto parts into untested robotics by next quarter, can they actually hold that margin hill?
That's exactly the risk here. Short term, the new segment actually dragged down their operating profit a bit. Pumping out those robotic muscles takes a massive toll on the consolidated numbers before they reach true scale. They really need the software side, like that new Cosmos spatial platform they're launching, to catch up and lift those margins back up.
Right, because building physical hardware, it's painfully expensive early on. But management seems confident in the sheer volume coming to offset that, right? I mean, they reaffirmed some pretty massive expectations for the back half of the year.
Yeah, they're modeling somewhere between 800,000 and 850,000 LiDAR shipments just for Q3 alone. So that seasonal auto snapback we mentioned earlier, that's really doing the heavy lifting there, basically subsidizing the robotics rollout.
It's such a fascinating pivot. They've built this dominant, highly profitable automotive sensor business, and now they're essentially using it to bankroll a moonshot in humanoids. But if open market customers don't start buying those modules soon, Wall Street's definitely going to lose patience with that Sherpa setup.
Exactly. The equity story's completely morphing. They're trying to transition from being an invisible airbag for cars to being the musculoskeleton for physical AI. If they pull it off, it's a brilliant hedge against those EV price wars. If they don't, well, it's just very expensive R&D.
Which makes next quarter an absolute must-watch to see how that revenue mix actually plays out in reality. All right, I think we've successfully dissected the cyborg rollout for today. Thanks so much for unpacking this with me, Miro.
Always a pleasure. Catch you next time.
If you're having fun with these breakdowns, maybe just tap follow on whatever app you're using right now. Just like those Dairy Queen robots, we're completely synthetic, meaning this whole show's an AI-generated experiment pulling the narrative together the exact same day so you don't have to read the filings. We're always taking ticker requests, so shoot your ideas over to earningsunscripted@datamadness.ca or grab the X link in the show notes.
See you next time.